How's it going, everybody? This is Joey from Universal CPA Review. In this video, we're going to talk about multi-jurisdictional tax issues that you might see on the exam. Okay, so keep in mind, this is everything that the AICPA blueprint outlines as testable stuff. And it's always going to be our job to do the best that we can to simplify this so that it is as understandable as possible so that you get that passing score that you're looking for come exam day. By the way, don't forget to subscribe to our YouTube channel or join any of our Facebook study groups. You can find the links to those in the description of this video. And if you find that you're more of a visual learner, our review course might be for you. We offer video explanations on every single multiple choice question and every single task-based simulation. So if this sounds like it might be a good fit for you, feel free to try Universal CPA Review for free today. And if you decide that you want to join our review course in a more permanent way and want to save a little bit of money, feel free to use discount code UNIVERSAL2021 for 25% off all Universal products. Okay, here we go. Showtime. We're talking about multi-jurisdictional tax issues. So we're going to consider both state and local tax as well as international tax issues. So as you're studying, you might think this feels sort of miscellaneous in the grand scheme of the REG exam. But I'm here to tell you that as miscellaneous as this might feel, this is very much within the blueprint. Okay, so this is an area that has been tested in the past. So we need to pay attention to the details as well as the big picture. So let's start by introducing you to our next company. This company is called Next Stop Shoes. Okay, so Next Stop Shoe Company is a Boston, Massachusetts-based company, and Next Stop does their own distributions. So they're going to be incurring their own freight expense. And keep in mind, this is not the FAR exam, so we're not going to be talking about how this would be expensed in the financial statements. That being said, there are some tax-related issues when it comes to distributions that go from one state to the next. Okay, so Next Stop does a lot of distributions across state lines. So they have what's referred to as interstate commerce, right? A lot of their customers are based out of New York. Okay, so when you're thinking about Next Stop, you're thinking nexus. Okay, so what is nexus? Tax nexus describes the relationship between a taxing authority and a business within a state jurisdiction. Okay, so for taxing authorities to levy tax on a business within a given state, it must have a nexus. Okay, so the general rule is that nexus must exist in order for a business to be taxed. But in order for that tax to occur, the business must have what's referred to as a significant presence in that state. So you could think of this as the minimum physical presence threshold in a given state before companies would be subject to respective state income taxes. All right, so we're focused on net income tax. So when Next Stop Shoes distributes from Boston, Massachusetts over the border to New York, then it's going to be considered engaged in this interstate commerce. So you're sitting there and you're thinking, oh, that's a fancy word. What does it mean to have interstate commerce? Don't feel bad. Nobody's watching. But interstate commerce includes all commercial transactions that cross state boundaries or that involve more than one state. So for example, when Next Stop Shoes distributes from Massachusetts to New York, then it is going to be making a sale from one state to the other. So the state of Massachusetts is going to be like, you owe us state income tax money. And the state of New York is going to be like, no, you owe us state income tax money. And the reality is federal laws are going to prohibit states from imposing net income tax on business activities that involve this interstate commerce. Okay, so keep in mind, once again, we're focused on prohibiting New York from imposing net income tax on Next Stop Shoes. So also keep in mind, they're still going to be subject to sales tax, gross receipts tax, and franchise tax. Okay, so if you're located in any state that has income tax advantages and you end up making sales to states with high income tax rates like New York or California, then you're not going to be required to pay those respective income tax rates, right? Because then no companies would ever want to sell to those states. And we can't have that, can we? Come on, New York needs its shoes. Okay, so think of this as the exception to the rule. And this exception came in 1959, and it stipulates that no state or political subdivision thereof shall have the power to impose a net income tax on persons, which include individuals, corporations, partnerships, and limited liability companies, that their net income is generated within the state by business activities from interstate commerce, if that business activity, and this is where it gets important, we're talking about those business activities that solely focus on the solicitation of orders of tangible personal property outside the state for approval. If approved, the shipment and delivery is made from a point outside of the state. Okay, so naturally, this is not going to protect corporations that are incorporated in such state or individuals that are residents of such state. Okay, so why does that make sense? Because if this company is incorporated in New York instead of Massachusetts, then the government is saying that by definition, your company is part of that state. So you're going to pay state income tax there. So Next Stop Shoes is going to pay state income tax in Massachusetts, regardless of their sales distributions to New York. And same goes for individuals in a state, right? If Next Stop is instead a person, then this is going to be a residency requirement. So in this case, the person would need to be a resident of Massachusetts. And if you sell to New York, you're going to pay state income tax in Massachusetts, not New York. So what does the government identify as a transaction that would trigger nexus? So keep in mind, this is a little bit subjective, but some common examples include the following. Could include sending sales representatives outside of state for work. Could be demonstrating ownership or leasing of tangible personal property. Could be a physical presence in the form of employees, property, or assets in a state, storing products in out-of-state warehouses, and providing installation or maintenance services to customers out of state. Okay, so the next thing we're going to talk about related to nexus is the rationale in the concept of allocation and apportionment. Okay, so these are two words that sound very similar, but also mean two completely different things. Okay, so when you're thinking about allocation, you're thinking about the association that the company has with its non-business income, whereas the term apportionment is going to be associated with business income. Okay, so let's start with allocation. Allocation signifies the removal of non-business income, which enables it to be taxed in the state of where the taxpayer resides. In other words, the company's home state. Okay, so when you think about allocation, essentially what we're doing here is taking this non-business income, which refers to all other business income outside of the taxpayer's regular trade or business operations. And examples of this non-business income can include any of the following. It can include net rents and royalties from real property where property is located. It can include capital gains and losses in the state where the property is located. Interest and dividends in the domicile state. Patent and copyright royalties where the property is located. Okay, so as you can kind of tell, this is all income that is outside of the ordinary course of business. Okay, so you might be thinking this sounds a lot like portfolio income to me. So if that helps, you can absolutely think of it that way. So let's say that Next Stop Corporation is delivering goods from its home state in Oregon now. And we need to identify, okay, what money is coming in that is actually from this interstate commerce. If there's an argument to be made that the resulting income from the exchange does not come from the ordinary course of business, then it is going to be classified as non-business income. Okay, so the general rule is that we're going to allocate non-business income to the company's home state. In this case, that would be Oregon. All right, so now let's talk about apportionment. Apportionment refers to the distributions of all business income for each state in which the taxpayer does business. Right, like we said, apportionment is going to be associated with business income. So when you're thinking about allocation, you're thinking non-business income. Okay, so what the exam might do is ask you to calculate a company's taxable income in its home state. And they might ask you for information that includes allocable income and apportionable income. So when it comes to apportionment, we're focused on three factors in our formula. We're going to focus on property, payroll, and sales. Okay, so this is the formula that we're going to be using. All right, so again, we have three factors. We have the property factor, which is calculated as a fraction that includes the value of real and tangible in-state property within the numerator and the total property value in the denominator. The payroll factor is calculated as a fraction that includes in-state payroll within the numerator and total payroll in the denominator. And finally, the sales factor will include a fraction that will have in-state sales in the numerator and total sales in the denominator. Okay, so now let's run through an example with our friends over at Next Stop Shoes to really show you how this works. Okay, so we're going to assume that Next Stop Shoe Corporation is headquartered in Oregon, but they also have operations in Delaware and Indiana. So based on the following breakdown of property, payroll, and sales in each respective location, we're going to determine the total taxable income, assuming allocable non-business income and apportionable business income are as follows. Allocable income would be $20,000 and apportionable income would be $80,000. Okay, so the first step is determining each state's total respective property, payroll, and sales. And then we're going to determine our property, payroll, and sales factors. So let's fire it up with property. Okay, so Delaware has $140,000, Oregon $110,000, Indiana, $180,000. The total property would be $430,000. When it comes to payroll, Delaware would have $20,000, Oregon $30,000, and Indiana $40,000. The total amount would be $90,000. When it comes to sales, Delaware would have $350,000, Oregon $450,000, and Indiana $400,000. The total amount will shake out to $1.2 million. Okay, so again, we're focused on Oregon. So starting out with our property factor, we're going to take Delaware's $140,000 divided by the total property value of $430,000, which would give them a 33% property factor. Indiana would take their $180,000 divided by $430,000 to give them 42%. All right, but again, focused on Oregon, we're going to take the $110,000 divided by $430,000 to give them 26%. Let's next focus on the payroll factor. All right, so Delaware would be $20,000 divided by the total payroll of $90,000 to give them 22%. Indiana would take $40,000 divided by $90,000 to give them 44%. And again, focused on Oregon, we're going to take $30,000 divided by $90,000, which would give them a payroll factor of 33%. Okay, and finally the sales factor. Delaware is going to shake out 29%, right? $350,000 divided by $1.2 million. Indiana, 33%. $400,000 divided by the total of $1.2 million. Okay, and again, Oregon, we're going to take $450,000 divided by $1.2 million to give them a sales factor of 38%. So now we could calculate Oregon's total taxable income while considering nexus. Okay, so while we're on the topic of apportionment, let's calculate Oregon's apportionable net income. So as we see in our formula, we're going to take all of our factors, we're going to add them up and divide them by 3. So we're going to take our property factor of 26%, add it to our payroll factor of 33%, and add that to our sales factor of 38%. So our total factor is 96%, divided by 3, which would give us a 32% amount. Okay, so our total factor of 32% will be multiplied by what? We're talking apportionment. When you're thinking about apportionment, you're thinking about business income. All right, so our business income is $80,000. So 80,000 times 32% gives the state of Oregon apportionable net income of $25,711. All right, so what did we say when we're thinking about allocable net income? When we're thinking about allocable net income, we're going to take our total non-business income and we're going to allocate it to the home state. Okay, so the home state of Oregon is going to allocate the entire $20,000. So we're going to take Oregon's total taxable income of $45,711, and this is the amount that is now going to be multiplied by Oregon state income tax rate.